All right, what's up? Here we go. SmartHelping.com here. It's a beautiful late August day in Ohio. Probably, this is my favorite time. We're getting cool, a little bit cooler, but not too cold. It's sunny. Had a nice hot tub this morning, feeling just loose. And I'll tell you what, it is a lot more fun knowing that the stream is going to have people in it when I used to come in, there's one or two people for the 2 hours. So this is cool. We're gonna finish this. Well, we're gonna get into the hotel acquisition more today. We probably might finish a lot of it. Before I get started on anything, let's sound check here. Looks good. Okay, Twitter. And don't forget, check out more models at smarthelping.com. I've got the real estate bundle is what I'm going to be adding to when I finish the hotel acquisition. It'll be included in here for $45 one-time fee. Um, I added a refund policy, and it's not really a refund. Um, this is just an update here, but I'm saying if you do buy a template and it was the wrong one, or you didn't think it was what it fit exactly, I'm doing one free exchange. So if you buy something, you can say, "Hey, I wanted this actually," and I'll exchange it one time for free. So it's basically like buy one get one, I guess you could say. Um, and then you can do it, for as many purchases as you want. Let's say you buy another template in 3 months, and you want a different one. That's fine. As long as you do one purchase, you get one free template. So that's new. Um, and if you want to buy all the templates, you can get a bulk purchase, $999 for all the templates that I own and have built here. Super valuable. Um, okay, let's jump in here. So I'm gonna do some stuff in Paint today as well, some visuals to show you some GP and LP stuff. I got into it a bit on Twitter, just asking about some things with the structure and acquisition fees because that's what we're going to be doing today. So I got some good insight from some of the more followed and popular real estate people on Twitter. So that was cool. We're gonna just try to uh, model some things today that I really needed some confirmation on. Let's see, pull up this. All right. So now I don't like to get started too much on things because it takes, I don't know why, but nobody's in here until about 10:15, and then there's a bunch of people for basically from that time until 11. Let me pull up the stream and see. Hope everyone's having a great Wednesday. Let's pull the stream up here. Okay. All right, so I can see if anybody says anything on my phone. So, well, let's review what we did yesterday. So yesterday I went through and linked up all of the financial statements. You can see income statement. We did a lot of stuff with taxes, net gain or loss on the sale of an asset, um, balance sheet, and everything went pretty well. No big issues yet. We'll see once I start play with some of the assumptions on the timing and make sure everything still balances. But we'll have to get all our sanity checks in here as well. We got the discounted cash flow analysis. Now remember, this is a very basic joint venture situation where you can account for investors and owners operators here in this case, but it's just a very basic structure where you have the distribution rates on any distributable cash flow months, and then the contribution rates on any negative cash flow months. And that just applies to the cash flows each month pretty simply. Um, we're going to have to update some of these visuals. Executive summary was completed, and then the monthly and annual detail where you see kind of all this stuff with occupancy and costs and all that. So we're going to spend a lot of time here. Let me zoom out on this. This is a GP and LP structure. We're going to spend some time on this for sure. And we're going to do some stuff in Paint. But I'm doing that when there's more people in here. All right, well, let's just get started. Let me zoom out. So acquisition fees. What is the acquisition fee? Well, these are all fees charged by the sponsor to the LP, and they do increase. As far as everything I've been told and everything I've modeled in the past, is when the LP pays this fee, it raises the equity they've contributed to the deal. So it's like the fees are part of the deal, just like closing costs or the purchase price of the building or the development cost of the building. So we'll have fees paid to GP by the LP. And these might be zero. And I'll go through more of the structure, but at a high level, essentially, these fees are going to be based on a percentage of each of these sections because the sections are bigger, and I've seen people have acquisition fees. I've seen renovation management fees. So what I'm going to do is actually allow a percentage of each of these sections to have a fee that goes along with it that's paid to the sponsor. It's probably a little overkill, but it's better to be overkill than underkill. So we'll have that, and then those fees will go to the deal, and then based on the equity requirements or contributions that you see on this waterfall right here, initial equity contributions, the GP could potentially be paid itself some fees, which is all that basically is saying is the LP doesn't have to pay the full amount. Now, if the GP is paying a 0%, then obviously the LP is just the fees are part of the deal, and since the LP is paying 100% of all the cash required, that 100% of the fee will go to the GP. So that's how that's going to work. Now, what is this referencing? A22. We'll probably have to change that to a hard-coded number. Yeah, this is not going to drive the waterfall. This is separate from that. So we want to manually, this is a completely separate thing. I'm also going to add an annual waterfall that's separate in itself. Okay. So let's say, if this was 100, then fine, the LP is paying 100% of the fee to the GP. GP doesn't contribute anything to that. They just get the fees. And then however this is set up, this could be 100% as well until the LP gets at 11% internal rate of return on all of the equity that they've invested. And then the sponsor could start getting some based on the hurdle rates. So that's kind of what we're working with here. So what I need to do first is let's put these fees in here. So I'm just going to put this in black. It's white. And I'm just going to reference the actual title because this could change. No, this is pretty static. So any acquisition stuff. What do we want to label this? And I guess we could just put management fee next to all this. So we've got that. Let's just drag this down to all these. And then we've got 31, 55. And you could overwrite all of this whoops, if you wanted your own labels for what the fee is called, or if you have your own fees that are based on whatever it might be, uh, you can just fill it in here, and you can fill it in by month. Now, this is not going to account for management fees as far as a, so this is just acquisition development. There's nothing here in as far as like ongoing operating fees. So, and I'll get more into it when I do the little visual and we get into the real structure. But we'll probably add a selector that says the fee can be based on a percentage of net operating income or gross revenues or a percentage of the total deal value, which will be the total um, contributions of equity. Now that's probably going to be the most common is just a percentage of revenues or net operating income, but I'll do all three, and it's going to be a little tricky here because on the waterfall I have any negative cash flows hit no matter what. So there's seasonality with the hotels, and it's possible that even in the future when you're operating really well, there could be negative months on the slower months. And so that's going to assume there's equity contributions required, even though maybe for the year it's, let's see, so 2029 in this case, you've got, actually no, that's negative. But let's just say it's net positive for the year. Now, if it was net negative for the year, yeah, you're going to need some equity contributions. And again, these assumptions are arbitrary that I have here, so it doesn't necessarily mean you're going to have negative cash flows in the far future with stabilized, hotel operating activities. But if it's, let's say this was year and you were plus 618,000, well, you wouldn't. These equity requirements would probably just pull from any working capital that has been earned over the period. And it wouldn't necessarily be an equity investment requirement. But to keep it simple, I've done any month that has a negative cash flow is going to go to a contribution requirement, and any positive cash flow month is going to be a distribution. And that is as simple as it is. Um, so that's another reason why I'm going to do an annual version of this as well. So it'll be a little bit more digestible to see it that way, and the hurdles and stuff will work on a monthly IRR based on an annual rate defined. But okay, so let's see. Um, hey guys, trickling in there. Good to see you. Got a couple you in here. Once we get a little bit more, I will jump into some visualizations about this. I want to do some paint just explanations about how this is going to work with the fees and the structures for the LP and GP. I'm just kind of talking through some stuff here. So, uh, yeah, so the fee, so if you made the fee on the total equity required in this case of 14.9 million, that's not, I mean, yes, let me just actually adjust the assumption so that we don't have such negative cash flows in the future, because it's not likely that that would be the case. Let's just raise the rate to 250 base, and that should do it. Wow, still, let's look at 2027 here, or 2028. So based on our seasonality, whoa. Okay, hold on. What do we put here for seasonality? Or occupancy is pretty low. Let's just change occupancy to like 80, 85, and then the higher months would be 95. I have pretty high staffing assumptions too. Let's look at the staff. This was just left in here from the assisted living facility model. Um, this might be high. This might be a little high. Let's just clear these out. Let me zero these out. Let's put a now the cost here, the staffing would be directly, you know, related to what the hotel is, if it's a bigger hotel or smaller. So when you actually go and fill out the simulation for your own uses, these numbers will make sense because you're putting in actual figures. Um, yeah, we have like 49 other staff here. That's obviously not realistic. And I need to change the names of these. Let's say this is other staff one. You don't need LPNs and stuff in a hotel. Uh, yeah. Okay. That's why there was so many negative cash flows because those costs were way too high. Wait, what? How are we all completely negative now? And I reduced costs by like 80%. Oh, hold on. Let's see what's going on here. All right. Oh, am I targeting the wrong row? Because we updated the monthly detail. So it should be targeting row 264. What am I targeting here? I was probably targeting, let's see, oh wait, no, distribution C6 and 5, which is 264. Is that the same? Wait, no, that's right, 264. Why are we so negative? No, these are all positive. Oh wait. Is it the refi? We're refi for 133 million. Okay, yeah, obviously you're not gonna take that's not right. Let's see. So why is that happening? Um, well, I guess we're saying we're doing 1 million a month now. 12 million a year. Yeah, at that cap rate, that would be 133 million. Okay, so we need to adjust this. Let's say the LTV is going to be like 10%. Now, again, when you fill out actual numbers for an actual hotel that you plan on, these numbers will make sense for whatever you're doing. But I've just put in random numbers essentially. So, yeah, we're not going to take out a $133 million loan. 26 million, that's more realistic. Okay, and now we're positive. So if we look here, okay, yeah, we actually don't have a negative cash flow at all. So that's more realistic. You'll have your negative cash flow for the first year or two while development you're getting settled. So this number here, total contributions will be an option to be used for a management fee as well. All right, remember we're just talking about fees here. So these are all fees paid to LP by the GP. We're going to base each one on a development or acquisition section. We've got a bunch of them. You don't have to use them all. You might use none of them or one of them, or you might override them here, but I'm just trying to make it as flexible as possible for all potential uses. Let's just say 5% on all of these. And we'll get into all the logic for how this is going to flow into the joint venture and everything else. And these will be costs that go to the total deal. So when we look at the deal as in itself, these costs will have to be added into the um, monthly detail and the income statement of the essential entity or deal itself. So we'll have to. Now it's not too hard. There's no real deferring or non-cash items. These are just fees that happen in the month that they happen. So B7, 31. Then I need 55, 79, 55, 79, and then 103 and 127. 127. The idea here is I don't know where the fees might be. some people have acquisition fees, some people have renovation management fees, and whatever else. You might be charging a fee for each of these sections or just one of them. You can toggle all those here, and we'll just say this is a percentage of the amount. Okay, we'll drag this down, and then these need to be the same. So 31, 55, 79, 103, and 127. So there's that. Good. Looking good. How many sections do we have? 1, 2, 3, 4, 5, 6. Okay. So there's those fees. And then we can roll these all up into one. Oh, wait. Yes. These can be rolled all into one. They're not, and all of these are going straight to the sponsor after whatever equity is required by the deal is contributed, and then this amount goes to the sponsor, whatever it is. Now, for something like, uh, let's see, like closing costs, this would be a fee that, um, or you might have closing costs. You could have, well, closing costs is the main one. This is a fee that goes to the deal itself and does not get paid to the sponsor, obviously. But all these fees are getting paid to the sponsor. Okay. So there's that, and we can total these because, again, they are all flowing to the same logic. And I'll show you how this is going to work here in a second with visualization in Paint. Okay, so there's that, and then let's see, do we have some people in here? All right, yep, we got people filtering in. So thanks for coming. All right, let's look at this structure here, guys. Now look at this. All right, so we're modeling GP and LP here in this deal. We have the basic structure, okay? There's a deal, oh, hold on. There's one deal. Here's the deal. Now, to get this deal done, you've got an operator that's going to kind of run things, manage the property, handle a lot of the work to get everything figured out as far as running the place, um, whatever the case. That is the GP. Okay, you have GP. Often they will not be contributing much capital. They might contribute some, but usually they're not going to be contributing a whole lot of capital because they're actually doing all the work. The other part is people with all the money. This is the LP, limited partner, and limited because they're just giving money and not doing a whole much else. They're in return giving more of the money, usually 90-10 or 80-20, usually not less than 80% of the total equity required, and sometimes 100% or often 100%. Okay, so and then the GP will get promoted if they give higher returns to the LP. An LP saying, well, I'll get less cash split percentages if my IRR is higher over time. So it's an incentive for the GP to do a good job. So that's the basic structure. Now, with a fee, let's look at an acquisition fee. So let's say this is 5% equity contribution, and this is 95. Okay. So GP is doing 5% of equity, LP is 95. Now for this deal, we have a cost, let's say it's 10 million. Okay. $10 million deal. There's potentially an acquisition fee that the GP charges to the LP on this 10 million. Let's say it's 1%. So what's 1% of 10 million? Let's see. I don't know if it's 100,000. Okay, so 1% fee. 1% fee goes to. Do we have an arrow? Whatever. So this 1% goes here. Actually, no. Let me rephrase this. This 1% adds to the total deal cost. So now the total deal cost is 10,100,000. The GP has to contribute 5% of the new amount. So let's say it's what I say, 10,100,000. So GP does 5%, LP does 95% of that fee, and the whole fee is then paid to the GP. So of this 1%, it goes here. Now, if it's 595 of the 100,000, 5,000 is paid by the GP to the pool, 95% paid by the LP. So 5,000, 95,000 goes into a pool, and then this goes back to the GP. Okay, so there's that. Now the other situation is this LP. I've seen it in a couple jobs I've done for clients, could be split into another fund that's going to be split into its own GP and LP. And what this would be is this GP is managing the fund, collecting money, doing the accounting, figuring out investments to make in big LP situations like this. So they're finding deals for these LPs. They're going to often be 0% equity contribution, and these will be 100. Now in this case, this GP will also charge fees on the deal to this LP. Now you can see how this gets a little tricky, but this is like a fund. This GP will have a bunch of these different investors that are investing into their fund. They're managing the fund, so they're going to often take a percentage of the total basically contributed cash of different deals. And they're going to collect basically fees only. They'll collect fees over time and up front, and they're not going to be contributing any capital. Now they all will take a split of profits as well, usually 20%. So this is where you see like a 2 and 20 deal. This is that. So it's like if an LP is split into its own situation. Now we are not doing this in this model. Okay? All we're doing is this. This is what we'll be modeling. It will have fees, but we're not doing a secondary LP fund that is added on. And usually if this were to happen, it would just be this GP that wants to do the model. Okay, so that is the explanation, best as I could show it. And now let's model it here. So uh, if we have all these fees being paid by the GP to the LP, let's go in here. So those are going to be fees as part of the deal itself. It's not going to hit net operating income. None of it is considered a management fee. Now, there will be a management fee that does hit net operating income, but not these. These are just essentially just on the acquisition. So now for the deal, I believe it could still hit the. I'm not a CPA, so I don't know exactly how it's going to hit the income statement, but I believe it's tax deductible fees um, for the deal. So we'll probably just put it in here um, above interest, and it will, or here below depreciation, and it will affect taxable income. It will reduce the taxes that I guess the entity is paying. Um, Now this won't matter for our structure for the GPLP deal. It's not gonna have any tax effects at all, so that's fine. Um, Let me double check where this is pulling from distributions. Yeah, so this I'm gonna update this to pull. Well, let's think about this. I guess we could just have it here, and it could pull after tax cash flow. I guess that's fine. Just trying to think. Yeah, I think that makes sense. Okay, so we'll float in here. So let's put this in. So GP acquisition, reno, other fees. Now again, it's not a management fee, ongoing management fee that we're going to model here. Okay, so if I go equals, where do we put that at? Here. So this is going to be a negative number. And now it's not, oh, here's the other thing. These fees are not, I'm trying to think. I just did this in a different model for somebody. I don't believe you can borrow against them. It's just going to be equity. And I think that's the more common case. So we are going to put these, actually, we need to put these down below all the debt and other stuff in the other cash flow. Let's put it down here. And then we'll put flows to cash flow row. Okay, so it's just a number that reduces cash flow, so we add it here. And it's a number that goes back to the sponsor, all of it. Now, like I said, if the sponsor has to contribute, let's say 5% of that fee, then this contribution rate 90, 27, 27, it's going to be including that. But so that's money out, but then they're going to be getting this money, all this money in, all of this fee. And then I'll probably do a summary that has, I've had clients ask for this, is you basically do a sponsor summary or GP summary where you see, okay, here's your income from fees, here's your income, here's your contribution distributions, here's your, from the actual deal itself, then fees, and then cumulative amount. Okay. So we've got this hitting cash flow here. Let's put this into the annual tab as well. Row 270. Let's get our sum ifs in here. Okay. And you see we're off by 865,000, which is this amount. So let's bring this in. All right. Now our total required equity for the deal has gone up to 9.6, which is the amount that we just added fees for. Let's see. So we have that in. We want to show that on the executive summary because you can see we're out here. So we'll put GP acquisition, reno, management fees. And let's just pull that in. So there's that. Add it here. Okay. And it's already hitting the distributions tab because that's pulling for the monthly detail, so that's fine. So these fees, now the second type of fee is an ongoing management fee, which, well, before we get into that, we need to add this. So that'll be into OpEx, but this one, I'm trying to think. Like, I guess it won't matter because you're not going to be selling in the first year or two when these fees happen. So I guess it's okay if the end net operating income is negative. So let's just put, we'll put these here. So this is going to be acquisition, reno, other, initial, GP fees, and then we'll put general ongoing management fee as our last one that we're about to model. All right, so this number we know is just going to be equal to this, and then general ongoing fee. Now for this one, there's a couple options. We could make this, what's going on, guys? Welcome in. We're just doing some joint venture modeling here for this hotel model. This is the last major section that we have to figure out. So this can be a couple different things. We can do it based on a percentage of gross bookings, a percentage of net operating income. Well, no, because it's actually going to be included in expenses, so it can't be percentage of net operating income unless it hit afterwards. So where are we going to put this? I guess the other fees are here, so let's do this. Other ongoing management fees. And I'm just going to put it at a percentage of, we're not going to get too crazy here. It's just going to be a percentage. Let's just put like 2%. And it will just be a percentage of gross bookings, which is this number here. Like I said, in other situations, if it was a fund that was a LP broken into its own structure, you would probably do it on the fund value, which is the total equity contributed. But we are not doing that. Oh, I locked the wrong one. So this is just to manage the property essentially. And the sponsor might be doing it, could be a third party. We're assuming that this is going to the sponsor, 100% of it. But again, this will be a number that can, like I did in the visualization in the paint thing earlier, it's going to affect equity required for the deal, but it doesn't start till cash flow starts, so it's not going to really require any equity. It's just going to be uh, essentially a fee that is coming out of the operations going to the GP. Okay, so that is there. It'll hit the income statement here. Okay, good. This is already summing that all up. Okay, drag it over. And there is that. So that's another stream of income for the sponsors. Uh, it will affect cash flow. Now, if we go over here to the monthly detail, we need to put that into, we'll put it right above total expenses. So that goes in here. Now, it's tricky if you don't do this a lot. It's easy to run into a circular reference error. And what would have been one here in this case is if I would have made it based on net operating income, put it as an expense before net operating income, then to be referencing itself. That obviously is not copacetic and it wouldn't work. Okay, so this is just a regular operating expense. Subtract or add this to total expenses. We'll add this to the annual. See, we're out. That's 3.3 million in fees there. So we put this in, add this to here. Okay. And so that will lower net NOI and will lower valuations if there is that fee in there. So we match the monthly. Let's look at the income statement annual. So this, let's update these terms. Column B. Oh, column B on this needs to equal this. Okay, and we just drag this down. And that matches perfect. All right. So we got these assumptions integrated. Let's see. This is cash flow. Are we out on the balance sheet? No. And so the cash flow is picking up those fees here in other OPEX. And what about, yeah, they're both in other OPEX costs. Okay. So that's fine. In monthly detail, they're here. Oh, executive summary, we're out. So let's put this here. Actually, and management fee. So annual detail C20 plus, so that's this plus this. And now that all shakes out. Alrighty, well, this is perfect. So we have management fee. We need to do an annual version of this waterfall. What I want to do, so the sponsor, we need to show the sponsor actually getting this money back. So what I do on these waterfalls, we'll insert some stuff here. Oops. And we'll put in, shoot. We'll put in the heck did I just do? No border. Um, other uh, acquisition, management, fees, fee income. Now that is going to be equal to, so remember they're getting all of the fees here and all of this. So they might have to contribute some of it to the deal depending on what their percentage of equity contribution is based on this up here. And then they get all of that fee back here. So they're the ones that benefit. The deal has to cover that cost. Let's get our lines in here. Left border and oh, I'm all messed up. This is this one. And this is bottom thick. All right. Now we add this. So actually, you can see here the sponsor is potentially not going to have any equity requirement because the fees that they're getting are higher than the money that they have to contribute to the deal, which looks like is probably true in this case. Let's drag this all the way over. And that, and as I do more client deals on this for modeling, I see that they are very often not net investing anything. Now, if this were 80/20, okay, now they do have a little bit of cost. And let's say it was 95/5, they don't here, but then let's say on the debt schedule, we're not going to finance, oh, we're only financing 50%. Well, that's probably actually going to be like 75/80. So that's going to even make it more positive. Let's say this is, let's say 90/85. So at 80, they still would be contributing some because the fee that they're still getting this fee as income, but the contribution requirements for the deal that they have to give are more than that. So their net amount is up here. Now this has to balance. So you can see how we're off by the exact fee amount here. That's because it's already coming out of this top cash flow, and then we're adding it back to the sponsor. So they're, it's coming out here, but then we're saying the money coming out here is actually going back to the sponsor, so that it will never equal this. So we have to zero that out in our check calculation by adding this fee into our check. Okay, and then everything else flows off of here, off the sponsor. Okay, so yeah, this is fine. So there you have it. Now what I want to do is a couple different things here. So we've got the basic deal structure down. We still need to fix some visualizations, and we have to do sanity checks. But before I even get into that, I want to do a sponsor income summary on an annual basis. And we actually can't do, well, we could sum up the monthly into an annual. Now, the numbers could potentially, I'm trying to think how this could change. Let's think about this. Do we need to do an annual waterfall is the question. I don't think so. The main reason why there were negatives before was because I had an insane refi that it was just based on arbitrary numbers. So that was not really realistic, and it was causing some things like debt service that was like way, way higher than it would ever realistically be. All right, so I think this is fine as is. We can keep it monthly. No need for an annual, but we do want to show annual summaries off of this cash flow. So annual GP and LP summary. So what we can do here is let's go year. We have up to 10 years. And what I want to show, let's freeze this. So sponsor summary, here's a sponsor summary. We can say contributions, which will be equal to this one down here. Distributions, which will be, and we want to keep this separate. So this is going to be summing up these tiers. This is all the waterfall stuff here. Wait, how is it none? Oh, shoot. I need to be using sum ifs, not, let's put this in gray here. So these are, I'm summing up the months, so I need to go, so year, do we have a year on this? This is month. Let's see, so up here I can go round up because we need a reference for the year, and we say it's going to be E10 divided by 12. And that should give us the year over time. Perfect. Now on this 210 million, what do we have our exit cap rate at? Let's just see here real quick. 6%, let's say 8%. Selling fees at 7. Okay. All right. So we have years. So now we can go sum ifs. Total contributions by the sponsor is going to be 80 if the year matches our year up here. Now, this is more likely to be 90 or 95, and in that case, you still have some contributions. So you'll see that there. But we also contributions, now distributions. Let's see, we need to drag this down. Let's lock these up. The money going to, and we can't do a sum ifs on a range, like I can't just sum up all of this, but it needs to be separate, so I have to sum it down here. Yeah, because we need to see that separately. And we'll just put that as like a italicized lighter gray. So that's 86. So we're giving the sponsor just basically a contribution distribution summary. Here's what they're putting in. Here's what they're putting out. Now they also have, we'll put acquisition, reno, other initial fee income, and ongoing management fees, fee income. Now for these, we're going to have to pull separately because we added them together and they need to be separate. So we need a year calc. Oh wait, we have it here. So we need to sum up 159 and 161. So here's all the initial fees flowing back to the sponsor. Sum if this, if the year is matching our year over here. And then same deal on this one, but it's a couple rows down. Row 161. You can see how if you rush this, it's error prone. You will make errors and it actually ends up taking longer. You can't rush this stuff. So nice and slow, you get it all out. So now we have we can put totals. They're actually positive here, and we can do a check on this by saying the sum of all of this should be equal to the cash flow amount here, which it is. Excellent. So we've added everything right, 121, which is adding up all of that, which is adding up this. Alrighty, and then sometimes you might want to see cumulative. And we can do that. Right there. We'll give this a thick bottom. So there's the sponsor summary. You can see where they're getting their fees, their actual distributions from the deal, and their contribution requirement, and the net amount. Now you can see the net is actually positive. If we go, I mean, you'd probably have to put, let's say if it was 80, then you have a small net negative. So you're putting in 858, you get 715 on the fees, net 143 contribution. Year two, you've got a little bit of contributions, but you've also got some profits. You've got fee revenue, and so there's your totals. Okay. Now, we can also do this. It's going to be a lot smaller or less rows, but we can do this for the LP. This would be investor LP summary. And so they have no fee stuff. We just have, we have to sum up these separate. Let's see. How do we do this? So just like on here, I had to sum up these to get it. I'm going to have to sum up LP. Tier 1, 2, 3 thereafter. So we got these totals. I don't know if you can hear the mowers out there. Sorry if you can't. They're going. And we'll give this italicized in a lighter text. All right, so 89, 89, 89. This is 89. And then their contributions are going to be more significant at 80. Okay, looking good. So their contribution, wait, that should definitely not be the same. What am I doing? No, it's not 80, it's 73. Yeah, 73 on the 73. So we have total LP, contributions, distributions, they have no fee revenue. And no, this contribution is going to include the fees that are being paid to the GP already. So we total this and check this against this, and it checks out. So these figures match the waterfall figures, and the waterfall figures are matching to the distribution schedule, and we are zeroing out on that check there. So we are looking good. Now here we might do a little chart as well. And man, I'm really excited. I mean, this is a great template. I'm excited to be finished with it. This covers so many, has a lot of stuff in it. It probably could be used for um, rentals as well as, well, short-term rentals because it's based on daily utilization. Um, Anything that's by day. I guess yeah, you couldn't really do it for a multifamily. I don't think you've got room counts. Yeah, because you got a daily rate there, you'd have monthly. But that's why. I mean, I haven't done anything that was specific for a hotel, so that's why we did this here, and it's looking really good. And I've added new uh, LPGP structures that I really like. So we've got a lot of value add to add this into the real estate bundle. All right, so we want this. Let's select our data. So let's just do the total, grand totals here. And here. Okay, label this total sponsor cash flow. Total investor cash flow. Put a legend in. All right, put these on low. Give this a little title. G sponsor versus investor cash flow. All right, and change these a little bit. Get this a little bit bigger. All right, looking good. So there we have it. Now you have total returns and IRR over here. Equity multiple IRR. And those are based on a monthly basis, which is the most accurate. Now also, a little lighter day today. It happens so. Also, let's get into our visualizations. So annual revenue by type, that looks good. EBITDA 15.8. Let's make sure that's good. Yep. Annual cash flow versus cumulative. 236, 164. Okay. Annual revenue versus expenses looks good. This actually needs a legend. Balance sheet. That's fine. Assets, liabilities. Okay, here. So EBITDA versus debt service and ratio. So we got to fix this. So EBITDA is, or it's actually going to be net operating income versus debt service. Is that okay? And perfect. So we also then want to put in the ratio. This will be a combo chart. Anything above one means your net operating income is covering the debt service, which is very important for the bank to see. They want to see how you're going to fund the debt. We need to make this a combo. And line with markers. Okay, now these, I don't like this. Can we fill this in? Do these bars, oh, that's kind of interesting. If you stack them, you can really see the proportions. The issue is I don't like the fact that they are, clear. I'll have to figure this out. And then after we finish getting all these visuals looking good, I will do the sanity checks, which is going to be interesting. Why are these transparent? I mean, I guess it's fine. Let's format this, no decimals. Uh, Axis label. This is debt service coverage ratio. And this is just representing NOI or debt service. So this is the ratio of this. You can see here's leading up to the refi. You refi, then your debt service coverage goes down a bit. Debt service goes up a bit. I guess it's fine, that chart. I mean, it works. It's no big deal. Annual revenue by room type. So here we don't need this. Now my question is, do we want to put in revenue by room type for all 20 of these? Is that really going to be that helpful? Because it's going to be hard to see. I mean, I could. So we could just go, let's remove all of this. Here I can just say, here's the revenue. We can switch this, make this the years. And there you have it, annual revenue by room type. And it's the same as the total annual revenue, but it's not showing each individual room type. That could be useful. We'll keep it. It'll definitely be useful if you have like 4 or 5 rooms and you want to see. Now, weighted average occupancy, we don't have, but we do have a total occupancy that we can put in here. So we'll clear this. Average occupancy, definitely a good one to have. And this is not weighted, it's just average occupancy. Clear this. Okay. So we go up to, and then we hit stabilize. Now, this is what that was basically doing. I do want to show another metric here, which is, do we have room occupied days? Yeah, that's what I do want to show. So this is saying of this room type for the given year, how many nights are you essentially booked? So it's going to be similar to this. And then that's probably the last visual that we'll do here. Okay, and this is total occupied nights booked by room type. Now that's the total. You could do a line that compares them, like say this, and then you could see. Actually, that's kind of better because then you could see how much each one is doing. It's a better comparison rather than just seeing the total. I mean, the total rooms booked is also good. 60,000 nights essentially year one, and you can see how much each one. We'll leave it here. If you wanted to do it, you just copy this and then just go to change chart type and go to line, and you could just do a line like this or a line with markers. All right, visuals looking good. Now the final step of the model, and we'll be done. This will be a full 5 days. We worked on this last Thursday, Friday, and then this week. Is doing sanity checks. And remember, we did have some suggestions a couple days ago by Mr. Silver, who said he wanted to do a model with sports agent commissions for professional athletes, also a laundromat and Airbnb arbitrage. So these three are on the works. We'll just see what we do tomorrow. I don't know. Assuming this is finished by today, which I believe it will be. So going in cap rate analysis also, so we could do that pretty simply. Where do I want to put this? We could pull this down a little bit. So going in cap rate analysis are really simple. If it might not be applicable either if you're building something, but if you're acquiring a hotel, then you do current NOI, and then going in cap rate is just based on the purchase price. Which do we have? That would be over in the acquisitions, which could vary. So what we're going to do is put that as an input. Purchase price. Here, blue, So purchase price, let's say it's, I don't know, 12 million. Current NOI, let's say it's producing 350,000. Going in cap rate is just the NOI divided by the purchase price. That's a very low cap. So let's say it's only 8 million. That's better. 5. Whoop. There we go. That's whatever. It doesn't matter. But this is just a little analysis you could do for going in cap rate if you want. And all this is saying is at 7%, you pay back 7% of the purchase price and NOI each year. Now, let's do our sanity checks. So annual net income versus monthly is going to reference to this. Balance sheet monthly is going to be, oh, my phone died. It's okay. This total. Balance sheet annual is going to be this. These should all always be 0. Hey, got a couple of you guys coming back in here. Good to see you. We're just doing some sanity checks. Um, we've structured the entire joint venture. If you want to see, we did the whole waterfall. We added fees. You can see they're pulling in here for the management fees and acquisition fees. All that income for the sponsor. It's flowing. We put it into the uh, monthly detail by showing. It hits, where did I hit it? So the management fee hits here and hits NOI. The acquisition fees, where did I put that? I put it down here and just flowed it into cash flow. So the net operating income on the monthly detail is going to be different than, actually, you know what? We probably should change that so they're the same. So let's clear this. So all these are going to be an expense to the deal itself. So these fees here need to hit total expenses, and this is coming through as a negative, so we got to go negative there. Because that's going to affect valuation, and we need to have the net operating income on the income statement be the same as on this monthly detail. Although I guess it wouldn't matter because you're not going to have likely, well, no, you definitely could have fees, the ongoing management fees, this amount. So, okay, so that's fine, just so it's all congruent. And on the annual detail, let's update that to, so take it out of here. And then put it in, all right, total expenses. Okay, there we go. And then that matches still. Let's make sure the waterfall still makes sense. Yeah, because we're pulling these directly. So I actually calculated the fees over here, and I did it as a percentage of each of the different acquisition, renovation costs, construction, everything else. So the GP could actually collect a fee percentage on each of these, depending on if they are or not, or you could actually manually hard code in the fees if you want. It doesn't matter as long as the box has the fee that's representative of what it is. Um, and then there's also ongoing management fee at 2%, which is going to pull from gross bookings. So that's what we've been doing all day, and then I structured it into the joint venture, and now we are doing the sanity checks. I did visualizations as well. All right, so annual detail. So this is looking at the monthly and annual. This check there. Annual detail against balance sheet. All right, let's look at that. So we have balance sheet cash flow at the exit month. Now that should be zeroed out against the ending annual cash flow here, as well as the equity contributed. Okay, we have a little bit of a variance here. Let's think about this. So what's 505,760? And I definitely fully expected there to be some variances here as we go to the sanity check. This could take a while, but let's get into it. So we're off on the balance sheet cash flow versus this. And the best way to figure this out is we look at the cash flow per month. And so we have this here. We want to look at the monthly detailed cash flow here. And then it should be zeroed out against any equity because the monthly and annual details don't include equity. Wrong sign. All right, so somewhere along the line these don't match, I'm assuming, and yeah, okay, so here's, and this is probably the variance. It looks actually huge. 241 million. Oh, right. So we have to also subtract out the actual net change in cash here. So these are all the same. Now, if this all matches, I don't know. We'll have to see what else could possibly be the issue. Okay, it looks like something on the exit. 239. And what are we out over here by 505? Is this a double? What's this times 2? No, it's not a double, but this is one issue. Are there? Oh, and here's the other one. And it appears to be 505,760. It appears to be, I don't know exactly what it is. It is the prepay penalty, I believe. Let's look over here. Prepay penalty. 266,340. So I guess what we did is forgot to put that on the income statement as an expense. I thought we did, or did we double count it? So that's definitely the number. And it's saying this is too high. Now, are we counting it double? Let's see. So this is doing 240, 47, 42, 51. 240, 247, 40, 47, 42, 51. No. Yeah, no. So that's not doing the fees. Let's just double check. All right. Uh, Borrowing is just the amount borrowed. So I believe what's happening is it is in the income statement. Let me double check. No, actually, I don't think it. Wait, is it an interest? No, it doesn't look like it. So if we go 237, 41, 48, 38, 37, 41, 37, 41. Oh, I gotta stretch my hands. 3741, and then 4838. Nope, those are just accrued interest. So it looks like the income statement was not accounting for these. Now I want to pull up the assisted living to make sure that it is in here, because this is the template I used to start, and I just want to make sure, is this counting? Now it should be, because it does balance. Let's see, when is there let's just double check. So when is the refi happening here? July 2023. All right, 86. No, that's not the refi, that's the initial loan. The refi is December 2025. Let's double check this just so I don't have to worry about it. So December 2025. This, okay. It looks like it's in other SG&A, and that makes sense of why the one I'm working on now doesn't have it, is because I redid these formulas. So let me just double check. 280, 287, that should be the fee amount. 280, 87. Yep. Okay, perfect. So I don't have to worry about that. Now, what I do need to do is add these back into the income statement. And then that should be all set. So I'll put these under other overheads. So minus prepay fee here. Let's go to the first month. And we're minusing it because it's coming through as a negative, I believe. Let me double check. Yeah. And we'll know for sure in a second. Let's see if that balances us out. Or it could make us double off, and then I'll have to do a different formula. Yep. Okay, so that balances. Good. Or actually, this did balance. What we were off on is the cash flow here. And now that is good. Perfect. So now if we go over here, yep, there you go. So now you can see annual check, annual detail against balance sheet is matched now, which is good. Just an issue with those fees. And that's what, like I said, the balance sheet is like a gigantic sanity check. And then you're checking your balance sheet cash flow against the annual detail cash is, if that's good, then you know you are good. Next up, we have executive summary to annual detail. Let's look at that. Here's that check. Yep, just making sure. Distributions to annual ending cash flow. Here's that one. Individual distributions against total. So here's our cap table. Here. Now this one I actually need to look through. I haven't looked at this yet. It looks like it's working fine. Let's do this. Monthly individual distribution. Okay, these last two, hold on for a second. Let's first go back to this cap table and make sure this is making sense. Okay, so we're taking total IRR. No. So we got to extend all the way out to column EE. EE. Now, is that something on the assisted living facility we didn't do, which is possible? Yep. So that's an update. Let me make a note of that. Update. That's a global update. Assisted living facility. Cap table IRRs. All right, we got to update that today and push that back out. And yeah, so when we ported this in, and I did an annual summary, I just didn't target the total. Now on the actual monthly calculations, you can see it is going over to EE. So these are the most important ones, which are correct. It's just on the annual summary, they are. Oh, wait a second. No, this does not need to. What am I talking about? It doesn't need to go to EE, but it needs to target the annual tabs. So it does need to be fixed still, but it's just a different. Uh, okay. Let me just put this in the cat table IRs for annual summary. So we'll put that on hold for right now. Let's finish the hotel one first. So here we want the IRR of the annual. So there's that. And we can just copy that and paste it. So very simple update, but definitely needed to be done or else you'd be really confused. So that's good. Let's format this here. Looking good. And then here's the actual IRRs on a monthly basis, which is more accurate. We did the IRR of the total range and then converted it to an annual rate. Now, this is good. We'll fix the assisted living probably this afternoon. Now, monthly individual distribution check against total. What was this doing? Let me look at this one. Ah, so I see. So this was the annual check. This is the monthly check. Monthly would be these two here. So that's good. Now, where am I? And then optional cash flow waterfall against ending monthly detail. I believe this is done, and it is this. Where is it? I guess it would be this total plus this total minus the fees, because those are already in the deal. And then that minus the annual ending cash flow here. Perfect. Okay. So, fingers crossed. Everything balances now. Let's try to edit some of these dates and stuff and see if we still balance down here. Because this is where you often see issues. All right, so we changed the end month. Let's do a partial end month. All right, all checked off. Let's do previous end year. Good. Let's do partial within that year. Nice. Now let's not include terminal value. Up. There we go. So first issue, balance sheet annual. Let's see here. So we're out by this amount, probably because we're not zeroing out something. So here there's no terminal value included. Let's see if it balances if there is. Yes, it does. So if yes, it balances. If no, we need to not. Let's see. So what something's going over. Let's see. Is it this? And we're ending on the partial year. Let's see. Assets are zeroed out. Liabilities should be zeroed out. Let's check here. What do I do on this one for balance sheet annual? So that's zeroed out. What about this one? Greater than C7. Yep. Okay, so that's the issue. Long-term debt, if we are ending the template before the year, or if this is a year after, this should be 0. So we simply do the same calculation, but if this is greater than our end year, zeroed out. Same deal here, but add this. Okay, so that's back to looking good. Now, we'll make sure this works. If this is yes, okay. Let's go back to full end year. Hit no. Let's go to partial in the last year. Looking good. Looking good. Let's go to the final end period. Good. And you wouldn't believe when I first started doing these models, having this selector of yes and no really helped. And this was the biggest issue with balancing the balance sheet and all the stuff was toggling these and making sure it works under any circumstance. All right, and it looks good. So this is all set. The model is done. I will update the index to match the new tabs for this hotel. We'll update these tabs with the new instructional video when I do that. But we're pumping out models. This is awesome. We got a bunch to do in the future. We'll start a new one, or I don't know what I might do tomorrow. I do want to stream, but we'll see. I might look into this Airbnb arbitrage deal. Maybe mess around with that uh, before we get into a brand new giant model. Now, let's also fix this assisted living real quick while we're here because this is going to drive me crazy. Whoops. So this just needs to do this. Top and double bottom. Okay. Now, why is the IRR 0 there? That does not seem right. Let's copy this here. $131. All right, what's the problem here? Come on, accelerate. What are you doing? Let's just take out the if error. Okay, so that's a little odd. I did the IR over here on the same calc, and it turned 0. This must be like an Excel thing. Equals IRR. This. Okay, what was different about the other calc? P116 Z116 IRR. I don't know. Well, there you have it. There's no internal rate of return for here because there's actually no negative cash flows on an annual basis. This is one reason why we put everything on a monthly so it's more accurate. But in case you wanted to run the analysis on an annual view, this will allow you to do that. All right. This is a little bit lighter. Format this. This was the first build where I actually went in and did everything on a monthly basis for all the distribution stuff and equity contributions and all that. And I really like how it turned out. So that's why and it was useful because it worked perfectly for the structure of the hotel model as well. Alrighty, drag this down. This is thick bottom. Alrighty, so this is done. I'll save the version of this, and this will be uploaded and get live on all the sites and everything today. So for that one, very minor update for that. Now this one's got everything, so we're good to go. I'll just update this today, do a video on it, and we'll be good to go. Well, thanks for watching. Good to see everyone here. I had a good amount of viewers. Remember, check out smarthelping.com for more templates. The hotel model will be included in here for $45 once I finish it and get it up. It'll be included in the real estate bundle for $310. And again, you can buy all the templates I have for $9.99. Check out smarthelping.com for more, guys. I will see you tomorrow.